So in this video, we're going to look at what is a financial crisis. So recently, everybody talk about we're going to have economic crisis, and will economic crisis cause the financial crisis? So obviously, the economic crisis is a little bit different from the financial crisis. So what is a financial crisis exactly? So let's look at the definition together. So what is financial crisis? So a financial crisis occurs when there is a particular large disruption to information flows in financial market, which with the result that the financial frictions increase sharply and the financial markets stop functioning. So obviously, when we look at financial crisis, we only focus on the financial market. So when we look at economic crisis, we look at broader picture like employment, like the purchasing power, etc. So the economic crisis sometimes can cause in the financial crisis because you can think about if people doesn't have enough money, the labor will lay off, the big business not doing well, and so the stock price corresponding to the big corporation will go down since the worker cannot find a job, and then the market will lose the confidence, and then the stock market is going to go down further. So that's how the economic crisis causing the financial crisis. However, financial crisis may not causing the economic crisis, may also causing the economic crisis, because if you look at the beginning, that the several chapters ago we talked about the stock market. So more than half 50% of the people in the United States have some kind of investment on a financial crisis, and also a lot of retirement money is put on the financial crisis, put on the financial market as well. So if the financial crisis is happening, you can imagine those money are shrink, and people gonna panic, and a big corporation, so stock value go down. It's affecting the value of the corporation, and the corporation might want to save in the cost and find the employee, and unemployment goes up, and then you're creating a lot of frustrated worker, and so that's starting a bad circle. So that's how the financial crisis causing the economic crisis. And here, when we look at financial crisis, the key characteristic that we can know the situation we're facing is considered as financial crisis. That is, the financial market stop functioning. So which means no matter how the Federal Reserve or how the Congress is going to try to save the market, all kind of policy implemented, the fiscal policy, monetary policy implemented, the financial market is still going down. So basically none of the investors having hope on the market. So that's when we can identify it's going to be a financial crisis. So we have all kind of uh, indicators to measure at what level we consider the financial crisis. And so you can see that the financial crisis stopped trading multiple times recently. And so because the stock price go down 5%, 15% in one day, and it was stopped trading for like half hours, etc. So those are the methods they use to save the market. If they lifted us the non lifted the non-trading, and the stock price still going down, and you given all kind of the physical policy, monetary policy is still going down 15%, keep going down. So that's when we are able to identify that's a financial crisis. So obviously, it is nothing. This is definitely something we don't want to see it happen. And so, however, if we can foresee this financial crisis might happen, and probably using the policies to given the confidence to the financial market. So we might be able to stop the financial crisis happening. So therefore, we're going to look at what are the important steps the financial crisis has go through. And if we will be able to identify those steps, and we might be able to stop the financial crisis happening at one of the steps. So let's look at the dynamics of the financial crisis. So all the financial crises, we can find a similarity, like in 1933 and the 2007 and the 1981. And we've noticed that they always have three different steps, three different stages. It always starting from initiation of the financial crisis. So initiation of the financial crisis, how it look like. So you will notice that on the financial in the economy there is credit boom or bust. So the mismanagement of financial liberalization and innovation leading to the asset price boom and the burst. So which means the asset price is far much higher than the value of the asset, and then suddenly people for some reason they suddenly notice that. This is the peak of the price, and then they notice that the value and the price is separated from each other too far, and people start to mass selling, and price dropped instantly. So that's when the boom burst. And then the asset price boom and burst. So for instance, like um, the the is course following the credit boost and burst, and then increase in uncertainty. Since the investor noticed that the asset price suddenly dropped, and before that point everything's going up, and so the panic move is mood is floating in the air, and investor get scared, and then that is when the uncertainty increased, and you will see the price is fluctuating up and down all the time because there is a trust issue, and some people believing the stock price goes up. Once the price goes up, and people say, "Oh no, the price is going to go down again," they start to selling, and the panic selling, panic buying. So that's the what happened in the stage one. So after that, we noticed that we're going to move on to the second stage and the banking crisis. So what happened is in the first stage, people borrowing money to buy the asset and to enjoy the boom period. And then suddenly the price goes down, and people lose their wealth, they lose the money, they won't be able to return the loan. And so if the bank cannot get their loan paying back, so they will have the cash problem, and plus the people who had a panic issue, they might go to the bank to withdraw the money, and then the bank had no money in the hand because they lent it out. Because, like I said, initially we had a credit boom, so their bank had the incentive to lend out of money. But since the boom disappeared and actually facing a sharp decrease, and the loan will be able to come paying back, and the individual borrower can file bankruptcy, and the bank won't be able to collect those money back, and so the bank are facing the crisis. And then the last stage will be debt deflation. So the debt deflation. So that is the three-step every financial crisis will experience. So now let's look at how these three steps are reflecting the real world case, real world event. So that is our global financial crisis between 2007 to 2009. So for this week's discussion question, we're actually going to look at how recent COVID-19 and might be able to set up the global financial crisis. And I want you to identify if we have potential to become the global financial crisis that is caused by the COVID-19. In order to answer that question, you actually have to discuss in a three stage. Stage one, stage two, stage three. So first of all, do you think stage one is the one going to happen, or might happen, or already happened? So if you think it's already happened, then you're going to discuss the second stage. Are we facing a banking crisis, etc.? So let's look at how we use these three stages to analyze this real-world event, global financial crisis between 2007 and 2009. So what is the cause of 2007 to 2009 financial crisis? So that is the financial innovation merged in the mortgage market. As we mentioned before, that how the bank can make monies. And so if they are lending the money for you to buy a mortgage, so for the bank, that is considered as illiquid asset, because that mortgage take you for 20, 30 years to paying back. So basically that money is sitting there and the bank slowly waiting you to paying back. So for the bank, it's not good because they want to have that liquidity so they can, based on the liquidity, to lend it out, get it back, lend it out, get it back, to make the profit, right? So therefore, they're relying on the financial innovation. So they create this financial institute of financial mortgage called a subprime mortgage. So basically, it's our first stage. We see the credit boom. So everybody have the credit score, and during that before 2007, what happened is bank had an incentive to lending the money to the people who have a low credit score to allow them to buy the houses. But you know that when people have low in credit score, they have high chance to default, which means they won't be able to pay back the mortgage. But the bank have incentive to lend money to those risky lenders. The reason is we have this financial innovation. They created this kind of submarine mortgage. securitize the mortgage. So basically, they bundles up the good and the bad mortgage in the whole package and send to the investment bank. So the investment bank separate this kind of big package into small packages and then sell it on the monetary market. So how are they going to sell it? As a security, which I like a bond. So why they can sell it? Because they are using the mortgage as backup. Because mortgage is the asset for the banks. So now they make a illiquid asset become more liquid. So that's why people notice that, okay, this is a good way for the bank to make money. So that's why the banker has incentive to lend money to the people with a low credit score, because they have, if they have holding more mortgage as an asset, the more they can create this kind of new financial instrument to sell on the monetary market to make money. So this is the first stage called credit boom. Credit boom. And so and then since more and more people purchasing the houses, supply and demand, that actually pushing the housing price goes up. So this is our second step, right? It is our asset boom. So asset price boom. So the housing price boom popped out, going up. So that increase in liquidity from cash flow surge to the United States. So even people outside the United States start to buy a house. And so there's development of the subprime mortgage market, fuel housing demand and housing prices. And so we see the credit boom, asset price boom. And so what happened next? And so the agency problem rise, because you can see the agency have incentive to selling houses. At that time, we don't have regulation. So the who praising the value of the houses are the ones selling the houses. So obviously, the appraisal had the incentive to higher value, to increase the value of the houses, and because they can sell the housing in the higher prices, but usually some of the houses are actually not worth that much. So that's a we call the 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 moral hazard, right? Moral hazard problem. So we have agency problem rises, and then and so the borrower actually, and also the borrower had little incentive to disclose information about their ability to pay, and the commercial and investment banks had a weak incentive to assess the quality of the security. But because everybody, the people who have lower credit want to buy the houses because they notice the housing prices going up, it become their investment. But they usually, if they have lower credit score, they have some financial issues to paying back. And on another end, the bank's supposed to managing what kind of people they can lend money, but they have incentive to sell more house, to lending more money to as a to selling more mortgages, and therefore both people are working together. So they are creating these big agency problems. And then after that, information problem surfaces and housing price bubble bursts, because eventually people will notice that, wait a second, this housing price is going too crazy, because the price of the asset is far more than the value of the asset. And people realize it, they had start to panic selling, and also for the housing price going so high, and some people borrow, so won't be able to afford it to pay the housing pay the mortgage back. So what is the effect of 2007 and 2009 financial crisis? So after the sustained boom, housing price began a long decline beginning in 2006, because people started selling the houses. So that's why the price started going down, because we had that bubble, it's burst. And so the decline in housing prices contribute to a rise in default on mortgages and the deterioration in the balance sheet of financial institution. Because let's say usually people borrow, like if the house they sold before the financial crisis is $300,000, and so then they saw the price going down, the value of the houses become only $250,000. Who are paying that mortgage see the value of houses started decreasing, and then they said, why I bother to pay the money back? Let me just default, because the house is not worth that much. So why you keep putting money in? Because the house usually also considered as investment for the individual. So that's why they stop paying the mortgage, and then the house become part of the asset of the banks. So what's the problem for the banks? The bank didn't want to own a bunch of the houses, so all the houses become foreclosure. So in order to be able to sell it, you can see instantly the market has more supply than the demand of the housing, and so the housing price keep even going down further. So that is the starting of the bad circle. And so the development in turn caused a run on the shadow banking system. And so the deterioration of the financial institution balance sheet. So this is our last steps. And so the banks start write down and sell the asset that credit restrictions. And so since all the big firm also invest on the subprime mortgage market, so since the value of the submarine mortgage value going down, and so those high profit firms fell as well. So Bear Stearns called bankrupt on March 2008. Fannie Mae and FedMac, so this is kind of semi-federal owned company, filed bankrupt in 2008 July, and similarly the Lehman Brothers, Merrill Lynch, AIG, and they're all facing the problem in September 2008. So that is the starting from the financial crisis and causing the economic crisis. The big firm fell. You can see the big firm fell means they're gonna fire employee and the employee losing job. Unemployment rate goes up. People cannot have money for the purchasing the necessities. So that's when the economic crisis happen as well. So what is the end? Who can end in this financial crisis? There has to be government. So that's why in 2008, and the House of Representatives vote down, started debating to have the bailout package, just like similar like what was happening during the financial this COVID-19. And so on September 29, 2008, and so the House of Representatives vote down the 700 billion bailout packages. So there's many debate between the two parties, so they actually voted down. And so they revised it on August 3rd, 2008, it finally passed. Similar like this time, the bailout is much, much larger than the 700 billion, right? It's $2 trillion this time. And so initial package got a vote down, and after renegotiation, 2 rounds, and finally it passed. And so the bailout packages, and so eventually Congress approved a $787 billion economic stimulus plan on February 13 and 2009. So that is how this financial package try to save the economy. And so does this bailout works? So the answer is yes, right? And so what is included in this bailout package? And so first of all, they did increase in the requirement of the regulation, and so I require all the banks to purchasing the deposit insurance. That's what we already seen. So they all, no matter it's the smaller thrift or the commercial banks, so they all require to purchase some kind of deposit insurance. And also they have different government regulator to monitoring what they are doing to make sure they are not only just try to be profitable to gain as many profit as they can, but also try to limit it or control the risk they are facing, and only lending the money to the people who have lower chance to default. And so that's the lesson we learned from the global financial crisis of 2007 and 2009. So it's pretty cool to have a perfect competitive financial the money banking system. However, if there is not enough regulation on the market, and so that's what we see in 2007, 2009, and so we will see the people, the banks who are pursuing the profitability as well might making an unethical decision. So that's why it's important that the government actually going to play a role during this whole process to helping the bank to run healthily, set up the regulation, and to avoid the agency problems. So in our next video, we're going to look at is the response of the financial regulation to to this crisis. Although we already mentioned a little bit, we actually gonna learn more detail what kind of policy has been developed because of this financial crisis.